It's time for Jordan Dove's Real Estate Market Pulse for the week of August 15th, 2022, where you're going to get what happened last week, what's going on in the national housing market, the national economic notes of the week, of course, the ever important inverted yield curve watch, and yes, it is still inverted. You're going to get the market update from my Southern Nevada friends and neighbors. You're also going to get the predictions for this week, some real estate headlines, and the oh so important Fed watch. Yes, Fed, we are watching what you do and not what you say. So let's get into it. I hope everyone's doing well, and make sure you like and leave a comment. Let me know what you think's going on in the market. I would love to hear from you guys, okay? So for last week's update, inflation was reported down and stocks were up big last week. The annual rates of both consumer and wholesale price inflation dropped in July. Those are the numbers that were reported anyway. And with the investors hoping inflation has started to turn the corner, that sent stocks up north big time. But unfortunately, the consumer price index, or the CPI, is at 8.5% year over year, and the producer price index at 9.8% are still elevated compared to almost any time in history, and it is miles above the Fed's 2% inflation target. So the news, the mainstream, they're going to try to spin this in a positive. Hey, we've reached the peak. It's starting to come down. Soft landing, whatever terminology they want to use. Stock market up, everyone's reacting. This is great news, but still, inflation is at historic highs. We had this back earlier in the year where we had that slight dip down just to go into a check mark right back up. So we're going to keep watching this and see what happens. But the Wall Streeters, they felt the Fed will now possibly go easier on rate hikes and were buoyed by the University of Michigan's consumer sentiment at a better than expected 55.1, though it is still historically low and well under its 70.3 read a year ago. So they're always trying to spin these numbers, make them sound great. But anyways, nonetheless, the market had a great week last week. The Dow was up 2.9% to 33,760. The S&P 500 up 3.3% to 4,280, and the NASDAQ up 3.1% to 13,047. Bonds overall moved higher. The 30-year UMBS 4.5% up 0.74 to $101.02. After falling for 3 straight weeks, the national average of 30-year fixed mortgage rates made a small jump up in Freddie Mac's primary mortgage market survey. And guys, remember, mortgage rates can be extremely volatile, so check with your mortgage professional. Ask Chuck for up-to-the-date minute information. Little did you know, there was a national online listing site that reports that stale listings, homes that are listed longer than a month, grew to 61.2% in July, up 12.5% from a year ago, and that is the first annual gain since the start of the pandemic. So let's move in. I'm the real estate guy, okay? The economics, go watch Chuck, go watch Greg. They're excellent. But moving into national housing news from your boy, the real estate guy, Realtor.com reports active inventory continues to grow, up 30% from 1 year ago. This jump in supply gives today's shoppers an extra home to consider for every 3 that were on the market this time last year. Freddie Mac is telling us declines in purchase demand continue to diminish while supply remains fairly tight. The consequence is that house prices likely will continue to rise, but at a slower pace for the rest of the summer. And yet, home price growth may be slowing, but the National Association of Realtors reports 148 out of 185 metros still saw double-digit annual price growth in the second quarter. That is 80% of the markets, and that's up from 70% in the first quarter. So even if we start having those price corrections, I do not think we're going to see a crash, but we are seeing a correction because pricing affordability is outrageous for the average household in the country. I do think that we will see a correction and prices begin stalling. We're seeing that now, but we are seeing activity picking up. Mortgage rates did dip below 5%. Very shortly. Now it's slightly above 5%, but we saw a lot of activity on our listings. We saw much more activity in buyer showings over the past week than we did, which means to tell me that buyers are getting back in the market. Also, in the last 6 recessions we've had, housing did not crash in all but one, and that was 2008. So just because we're in a recession does not mean that the housing market is going to crash. The last 5 out of 6 recessions had a cool down, but not a crash. So let's get into some economic notes. The consumer price index, as I told you, 8.5% in July, less expected as inflation pressure eases a bit. A report show inflation from June 2022 to July 2022 saw a 0% change in inflation month to month. Something I like to look at, because this is something that we all have to do, is food. We eat at home, we grocery shop, we eat out, whatever it is. But food inflation data in the United States hit 10.9% in July. That is the highest level since May of 1979. The food at home index rose 13.1%, and away from home, so eating out, that was up 7.6%. Second quarter GDP numbers, as we know, had a growth rate of negative 0.9%. Signaling 2 consecutive quarters of negative growth. They still have not said that we are in a recession, although that is the textbook definition of a recession. They're trying everything they can do to not let the consumer believe that we are in a recession, despite all of the data, despite saying inflation at 8.5% is great compared to 9.1% the previous month. So let's move into the bond yields. We remain inverted, which is a strong indicator of a recession. 30-year Treasury bond yield at 3.099% this morning. 10-year Treasury bond yield 2.788. The 5-year at 2.912. And the 2-year inverted with all of them, higher yield 3.201%. That means the 2-year bond yield is invested with the 5, 10. It's inverted with the 5, 10, and 30 year. And it's really amazing that anybody would buy debt at 10 or 30 years when a 2-year is paying a higher premium. All right, it just doesn't make sense to me, but hey, what do I know? Anyways, local Southern Nevada for my Nevada people, my Las Vegas, Henderson, North Las Vegas. This is what's going on. I've actually changed the format. For the last 6 months or so, I've been comparing the numbers to the week prior, but in real estate, data is usually done on a monthly basis. So I'm going to start comparing these numbers to 4 weeks past. And the reason for that is because the majority of homes and properties, you always try to sell at the end of a month, because that will save you in prepaid interest that you have to pay. So if you close in the middle of the month, say the 15th, you're going to pay 15 days of prepaid interest. If you close at the end of the month, you'll pay 1 day or 2 days, right? So I'm going to start running this data against the 4-week average from 4 weeks ago. If you want the actual numbers, make sure you sign into our Substack. Sign up, jordandove.substack.com. We send it out every Monday. It'll have a breakdown of all the numbers. You'll see some graphics and charts and all that good stuff. So if you want to see the breakdown of the numbers, because I'm not going to break down every number on the video, go subscribe to the Substack, and I will leave a link in the description below. All right. So I'm going to move into the absorption rate first. For Southern Nevada over the past 4 weeks, the absorption rate is 23.17%. That's down just over 1.5% from last week's absorption rate. And to put this into context, a little bit over 6 months ago, the absorption rate was over 100%, which is a number I've never seen in my career, and I don't think anybody has ever seen a number like that who's been practicing real estate for decades. And to explain what an absorption rate is, if it's above 20%, that's typically called a seller's market, whereas an absorption rate below 15% signals a buyer's market. So each week I'm going to start updating the current median prices for the current month, but keep in mind the majority of sales occur at the end of the month, so the official median price numbers will be published on the first Monday of each month in the newsletter and on the video. Okay, so currently the median August prices for single families in Southern Nevada, $450,000. That's down from July of $465,000. That's down from our peak in May of $482,000. But then again, we saw activity pick up this week. We don't know what's going to happen in the next couple weeks. We'll have the final numbers in the first week of September. All right, condos. This was an interesting one. The median price currently of condos for the August month of 2022, $245,000. That is up from July, and I was surprised when I saw this number. It's up from July, $238,978. So we have, just about a $6,000 price increase in condos. And townhomes, they are down from July. In July, it was $329,000. Currently, for August, the median price of a townhouse only down $2,000, not a huge difference right now, $327,000. But I want to talk about that condo median, that it's up from July while single families and townhomes are down. I believe that this has to do with the housing affordability crisis that we're going in, and home shoppers and investors, they are opting for lower priced condos as rents are still high and at premiums, and it has a lower entry cost of ownership. On our condo flip we received an offer, tons of action. It is cash offer, investor who wants to rent it out, and the prices are much more manageable. If you can find 2-3 bedroom condos, around 250, 260, 270, and some below in different areas in different condition, but that's much more affordable than, say, paying $2,000 or $2,200 a month in rent. So we are seeing buyers jump in to these condos, which is driving that price up for August. Really interesting marker right there. Really interesting piece of data point. So anyways, moving on. The past 22 weeks, we've seen an increase of residential resale inventory available on the open market in Southern Nevada. I'll put a chart here which shows the total available inventory to the total closed sales. This week, there are 161 more active residential resale properties on the market compared to 1 week ago. We have a total of 10,850 available residential properties on the market. That's an increase of 1.51%. And this includes single families, townhomes, condos, high rises, and multi-families, as well as manufactured homes. Okay, so that's all the residential. It does not include land or residential rentals. This week we saw 1,220 new listings and 546 properties sold. Of the 10,850 properties available on the market, 1,903 saw price decreases or reductions in the past 7 days. So we are starting to see some stabilization in the market. We're not seeing as many price reductions, but there are still quite a bit because the numbers were very high. A lot of sellers wanted to get March, April, May money, and the market, unfortunately for them, has shifted, but real estate has always traded hands. It always will. Still a good time to sell. If you're a buyer, opportunities are starting to arise. You now have more options. Sellers are giving you concessions. They're paying for those home warranty again. You can buy down your rate. You can get a reduction in the purchase price. For agents, the fees are being higher again. The home builders are offering crazy incentives to try to purchase a home. They'll give you the upgrades. They'll pay for your closing. They'll guarantee you a certain rate if you use their lender. They are doing what they can do, but the prices are still there. So I think the new construction is actually going to level off, but they're giving the money in the form of incentives. But when that property records in the county records, you're going to have that price stabilize. But then again, people are now taking advantage of all these incentives that they're offering. All right. So, a few real estate headlines. Home builders, speaking of home builders, they see a housing recession as the builder sentiment drops further into August, and the home builder confidence index fell to 49 in August for the 8th straight month, which was, to me, to be expected, but economists surveyed by the Wall Street Journal expected the number to be 54. All right. China's house market troubles need a holistic solution, says HSBC. And Jing Liu, the chief China economist at HSBC, she discusses the outlook for China's property sector and the impact that the country's zero COVID policy has had on the economy. You also have Evergrande with their defaulting rates and people backing out of mortgages and not paying their mortgages in China. It's going to get really interesting to follow that. Excuse me. If you want to link to that video, make sure you get to the Substack. I have links to these articles. A local article we had was Las Vegas housing market gets a slight break as mortgage rates dip. Sales have been tumbling in Las Vegas and around the United States, but if borrowing costs keep falling, it could spark more buying activity, which I do hope rates come down, prices come down just a little bit, and everything becomes more affordable and everything will start moving again. But I think that's going to take some time to get to that point. I'm going to make some predictions for this week. Home building and existing home sales are going to slip. Retail sales are going to slow, and we also get the Fed minutes. Analysts expect housing starts and building permits will slide for July, and existing home sales will drop below 5 million units a year. July retail sales forecast maybe up just a tick, scaling back from their growth in June. And we're going to scrutinize the FOMC minutes from the Fed's July meeting, and we're going to be able to do that to gauge their view of future rate hikes and the economy. So speaking of the Fed, in the newsletter we have a Fed Reserve Watch of what we expect them to do with the Fed rates. And so we're forecasting Federal Reserve policy changes in the coming months. So the Fed watchers, they now expect a 0.5% rate hike at the next two meetings, followed by a 0.25% kicker for the last year's move. Everyone's been speculating 0.75 point, but they have now shifted that to 0.5 point in September's meeting, 0.5 point in November's meeting, and a 0.25 point in December's meeting. The current rate is 2.25 to 2.25. 2.25 to 2.5 is the current overnight rate from the Fed, and they're saying that there is a 100% probability that the Fed will raise rates at least 0.5 point in the September FOMC meeting. So that's it for the Monday market update. I hope everyone is doing great, doing well. If you know someone who follows real estate, wants to know what's going on in the industry, share this video with them, share it on your YouTube channel. Make sure you like and subscribe. I would really appreciate it. I love getting out here and doing the videos. It's kind of hard on real estate to do a video every single day because real estate takes time for the data to come in, but I really want to be consistent with the Mondays and then throw in some fun stuff in between, maybe start doing some more shorts. If there is a video you guys would like for me to do, a topic you would like me to discuss, just hit the comments. Let me know what you want me to talk about and share with you. If I don't know, I will find somebody that knows and get you the very best information, all right? So you guys have a great week. I hope everyone's doing well. Be healthy. Take care. We'll see you next time.